Hi. Let's learn about managed accounts today. A managed account is an investment account that is owned by an investor but managed by somebody else. The account owner can be an institutional investor or an individual retail investor. A professional money manager is then hired by the investor to oversee the account and the trading activity within it. The manager has discretionary authority over the account and actively makes investment decisions relevant to the individual, considering the client's needs, goals, risk tolerance, and asset size. Managed accounts are most often seen among high-net-worth investors. A managed account may contain financial assets, cash, or titles to property. The money or investment manager has the authority to buy and sell assets without the client's prior approval, as long as they act according to the client's objectives. Money managers often have minimum dollar amounts on the accounts they will manage, typically starting from $50,000. The managers will usually charge an annual fee for their services, calculated as a percentage of the assets under management. A new innovation to managed accounts aimed at lay investors is the so-called robo-advisor, which provides automated, algorithmically driven portfolio management with little human supervision. Managed accounts and mutual funds both represent actively managed portfolios or pools of money that invest over a variety of assets, or asset classes. A mutual fund is a type of managed account. The professional managers of both types of accounts have the duty to act in the best interest of the client or potentially face civil or criminal penalties. A managed account is personalized and customized, while management of a mutual fund is on behalf of the many mutual fund holders and all about meeting the fund's investment and return objectives. With a managed account, the investor allocates funds, and the manager purchases and places physical shares of securities into the account portfolio. The account holder owns the securities and may direct the manager to trade them as desired. In contrast, mutual funds are classified by investors' risk tolerance and the fund's investment objectives, not by individual preferences. Also, investors purchasing shares of a mutual fund own a percentage of the value of the fund, not the fund itself or the actual assets in the fund. On the transactional side, events might move more slowly in a managed account. Days may pass before the manager has the money fully invested. Shares of mutual funds, however, may typically be purchased and redeemed as desired, daily. The professional guiding a managed account may attempt to offset gains and losses by buying and selling assets when it is the most tax beneficial to the account's owner, while mutual fund shareholders have no control over when portfolio managers sell the underlying securities, resulting in potential tax liabilities. In July 2016, managed funds were in the news, as several institutional investors simultaneously opted for them over the hedge funds that had been handling a portion of their portfolios. The investors wanted broader platforms, customized strategies, full control over their separate accounts, daily valuation, significantly lower fees, and full transparency when it came to those fees, as well as to the nature of the holdings themselves. Here are 4 key takeaways. 1. A managed account is a portfolio that is owned by one investor but supervised by a professional money manager who has been hired by that investor. 2. Money managers can demand 6-figure minimum investments to manage accounts and are compensated by a fee, calculated as a set percentage of assets under management, AUM. 3. Robo-advisors offer algorithmically managed accounts at a lower cost for everyday investors with low starting balances. 4. A mutual fund is a type of managed account, but it is open to anyone with the means to buy its shares, rather than personalized for a particular investor. Hope this would help. Thanks for watching.